Hello, this is Choworld. Today, I will comprehensively examine TSMC's fourth quarter performance, JIMROGERS' complete sell-off of U.S. stocks, and issues surrounding big tech valuations. In the fourth quarter, TSMC's revenue increased by 39% compared to the previous year, and its earnings per share (EPS) rose by a remarkable 57%. This company's gross profit margin reached about 59%, and its operating margin stood at 49%. This can be seen as a result of combining technological superiority in the semiconductor foundry sector with economies of scale. Notably, the 3-nanometer process accounted for 26% of sales, and the 5-nanometer process for 34%, meaning that over 60% of its total revenue comes from advanced processes. Since its listing in 1994, TSMC's revenue has grown at a compound annual rate of around 18%, and its EPS has also increased by about 17% annually. Despite such rapid growth, the fact that it has steadily increased its dividends makes it quite appealing to long-term investors. Even though it has built factories in the US, Japan, Germany, and other locations for global distributed production, its profitability remains strong because it has maintained high yield rates throughout the entire design and manufacturing process. There are market projections that TSMC's EPS will exceed $10 in 2025. Although some point out that its PR is already around 24 times, it is still considered a reasonable valuation for a high-growth stock. Now, let's move on to the news about JIMROGERS completely selling off his U.S. stocks. He is a master of global macro trading. So why has he taken a negative stance on the U.S. market? He believes that various macro risks facing the United States, such as fiscal deficits, debt, and interest rate inflation volatility, are interacting in a complex way. Nonetheless, he has not yet taken any short positions. JIMROGERS tends to favor holding dollar cash and commodities, especially silver, because he has witnessed multiple times that when the global financial market wavers, the dollar often strengthens instead. There is also a claim that big tech companies are in a priced-for-perfection state, meaning their stock prices already reflect a scenario of flawless future growth. Therefore, if growth falls short of expectations, or if valuation pressures increase, for instance, due to a sharp rise in government bond yields, there are warnings that stock prices could fluctuate significantly. On the other hand, we cannot ignore the fact that U.S. consumer indicators are currently quite positive. Bank of America credit and debit card spending increased by 4–5% year-over-year, and year-end retail sales were up 4%, while online sales rose. This appears to be the result of strong purchasing power among the middle class and above, combined with factors such as stable oil prices. Major U.S. banks also posted strong fourth-quarter earnings. However, there are ongoing assertions on Wall Street that if the bond market is shaken by rising long-term interest rates, then heightened volatility in the stock market is also inevitable. In the end, blue-chip semiconductor stocks like TSMC are highly likely to secure growth through outstanding technology and strong investment. But one should still be wary of the macro risks looming over the U.S. stock market as a whole. In summary, JIMROGERS' complete sell-off may be a signal of serious concern about the U.S. market, while TSMC, on the contrary, can be interpreted as having an opportunity to further strengthen its profit base. Big tech is still exposed to accusations of overvaluation, and one must always keep in mind that it can be easily shaken by external factors such as interest rates or macro uncertainty. From an investment standpoint, it seems effective to diversify one's portfolio, maintaining a balanced mix of high-growth companies and defensive assets. That's all for today's news. If you found it helpful, please subscribe and like. Thank you.